In every country around the world, taxation forms the backbone of public finance. Taxes fund essential government services, education, healthcare, infrastructure, social welfare programs, defense, and much more. Yet how tax burdens are distributed among citizens varies greatly and remains one of the most contentious issues in politics, economics, and society. Imagine a scenario where all taxes, income, sales, corporate, property, payroll, and even indirect taxes like VAT are paid solely by the top 20% of richest individuals. What would that mean for the economy, public services, wealth inequality, and everyday life? Would this policy help create a fairer society, or would it lead to unintended economic consequences? How would it change the incentives for both the wealthy and the rest of the population? In this video, we dive deeply into this fascinating hypothetical to understand its complexities and implications. Taxes are traditionally structured progressively to some degree, meaning that the wealthiest pay a higher percentage of their income. However, in most countries, the tax base is broad and diversified, with contributions from all income groups. Sales taxes and VAT hit everyone, while payroll taxes fund Social Security and unemployment insurance, paid by both employees and employers. Property taxes fund local services, and corporate taxes are levied on businesses of all sizes. In a world where only the top 20% pay taxes, all other income groups, from the working class to middle-income earners, would effectively be exempt. This could mean zero income taxes, sales taxes, and even no payroll or property taxes for the bottom 80%. At first glance, this sounds like a dream come true for the majority of people who would keep more of their earnings and face fewer financial burdens. However, the consequences of this arrangement ripple far beyond simple tax payments. Governments depend on broad tax revenue streams to fund public services that benefit society as a whole. If the tax base is restricted to only the richest fifth of the population, the overall tax revenue will either shrink dramatically or require very high tax rates on this smaller group to compensate. Both scenarios carry significant implications. If tax rates on the top 20% remain similar to current levels, the total revenue will fall, forcing governments to cut spending or increase debt. This would likely reduce funding for public goods such as education, healthcare, infrastructure, and social safety nets, affecting everyone, especially lower-income individuals who rely more heavily on these services. On the other hand, if governments increase tax rates substantially on the top 20% to maintain revenue levels, it would create a very high tax burden on a relatively small group. High tax rates on the wealthy can discourage investment, entrepreneurship, and economic growth. People might seek tax avoidance strategies, relocate assets, or even move to countries with lower taxes, shrinking the taxable base further. The labor market could also shift. With the bottom 80% no longer paying income or payroll taxes, there could be an increase in disposable income for these groups. This could boost consumption and demand for goods and services, potentially stimulating economic activity. Yet, since the wealthy would be paying all taxes, the cost of capital and investments might rise, possibly slowing business expansion and innovation. Additionally, zero sales or VAT taxes for the majority would remove one of the most regressive taxes, since sales taxes disproportionately affect lower income groups who spend a larger portion of their income on consumption. Eliminating these taxes for the bottom 80% could reduce poverty-related financial burdens. Yet without this revenue, governments would either have to cut services or heavily tax the top 20%, creating new challenges. Social equity and perceptions of fairness would become central in public debates. While many may view this system as more just because the wealthy pay for everything, others could argue that the middle class and working poor avoid their fair share of responsibility for supporting society. This could generate social tensions or political instability. Looking at historical and international examples can help shed light on this scenario. Some countries, such as the Nordic nations, maintain high tax rates on top earners while providing generous public services. Yet even there, the tax system is broad and includes contributions from all income levels. Conversely, tax havens and low-tax jurisdictions often attract the wealthy precisely to reduce their tax obligations, which drains revenue from countries with higher tax burdens. If the top 20% are the sole taxpayers, incentives to avoid or evade taxes might increase dramatically. Economic theory also suggests that tax burdens need to be balanced carefully. Overly concentrating taxes on a narrow group can reduce economic efficiency, innovation, and overall growth, while broadening the base with moderate rates tends to be more sustainable. On the public finance side, governments rely not only on income taxes but also on corporate taxes, property taxes, and indirect taxes like VAT. Eliminating these taxes for the bottom 80% would mean rethinking how governments fund themselves entirely. This might require expanding government borrowing or cutting critical programs. Moreover, public goods such as roads, schools, public transportation, law enforcement, and healthcare benefit society at large. If funding is reduced due to a shrinking tax base, the quality and availability of these services may deteriorate, disproportionately affecting the lower income majority. Another consequence involves wealth concentration. The wealthy paying all taxes would see their net income squeezed, potentially leading to slower capital accumulation. Meanwhile, with no taxes on others, wealth inequality could widen further since the middle and lower classes would have more disposable income, but limited opportunities for wealth growth compared to the wealthy. Political consequences might include intensified lobbying and influence by wealthy individuals, who now hold even more economic power. This could threaten democratic processes and increase inequality further. However, there are alternative perspectives. Some argue that the wealthy already benefit the most from existing economic systems and infrastructure, so it is only fair they pay for it. Others contend that broad tax participation fosters social cohesion and shared responsibility. To explore the practical implications, consider the impact on various sectors. Education funding might decline without contributions from the broader population, affecting public schools and universities that serve all classes. Healthcare systems, particularly those publicly funded, might face budget cuts, worsening health outcomes for vulnerable populations. Infrastructure projects, roads, bridges, utilities, require stable, predictable funding. If reliant solely on the wealthy's taxes, funding might become volatile, leading to underinvestment and economic inefficiencies. Social welfare programs such as unemployment benefits, housing assistance, and food security might see reductions, placing more strain on non-governmental organizations and communities. In the labor market, the absence of payroll taxes for the bottom 80% could raise employment incentives, but high tax rates on businesses and wealthy investors might reduce job creation overall. Financial markets could see shifts as wealthy investors adjust portfolios to optimize tax liabilities. Capital flight, tax avoidance, and offshore investments might increase, reducing taxable income. Internationally, countries adopting such a tax system could face capital outflows as wealthy individuals seek more favorable jurisdictions. This might prompt competitive tax policies globally, complicating international cooperation on tax justice. In conclusion, while shifting all tax burdens to the top 20% richest people might seem like an appealing way to reduce inequality and ease burdens on the majority, the reality is far more complex. The economic, social, and political ramifications would be profound and multifaceted. Policymakers must weigh the trade-offs between equity, efficiency, and sustainability when designing tax systems. Broad-based taxation with progressive elements often proves more stable and fair in the long run, supporting both economic growth and social welfare. Understanding these dynamics is essential as societies grapple with growing inequality and fiscal challenges worldwide. Ultimately, no tax system is perfect, but striking a balance that funds public goods fairly without stifling economic vitality remains a critical goal. Thank you for joining this detailed exploration. Please like, share, and subscribe for more deep dives into economics, policy, and global issues.